A little bit of philosophy, a little bit of therapy, a little bit of trading all wrapped up into one.
We're going to talk about our current trades that are giving us issues.
How to fix your entire life in one day.
Sometimes there's certain things that light a spark under you.
You set your expiration date before the earnings date.
I'm not against people trading through earnings.
Well, explain what an earnings trade is.
It's very complicated.
You aren't where you want to be because you aren't the person who would be there.
What would you do if you were in that situation?
You're losing money, you're getting discouraged because you don't know how to do it.
To me, the real world is
He's not taking the steps to become a successful trader.
$1,000 on one side, 500 on the other. Like, what do you do in that moment?
I'm a huge fan of taking a small loss to avoid a larger one, but
All right, episode 6 of Behind the Trade podcast. Welcome back, everybody. Greg, how's your day going?
great, Nick. How's your day going?
It's going. I'm tired. I got up early to go for a workout. Happy I did, but I've been spending a lot of nights staying up late working.
We've been busy.
We've
been
busy.
really busy with work, our regular jobs, with the pod, with the course, with some other things we're working on that we're excited about. It's a grind right now, but sometimes it's just the way it's got to be.
Yeah, I'm happy we make time for this podcast. We got a lot of good stuff to talk about today. I'll just run through the docket here quickly. We're gonna start off with questions from you, the people. Questions that have been sent in from viewers, people who follow us on X. Again, you can follow me at Nick Gibbs IAG, should be right here somewhere, and Greg on Greg Proctor at Greg Proctor. His will be this, but on that side. So you can follow us there. But we had questions that we requested and people sent in. So people have DM'd us. Greg put out a post on X to ask for questions. So we're going to answer like 4 or 5 questions that have been sent in. Really good questions.
They were really
insightful
good questions. Yeah.
So excited to get through those. Then Greg wanted to discuss the perfect market theory. So we're going to talk about that. We decided not to discuss our opinions on it. They might be very different. So we'll see where that goes. And then we're going to talk about our current trades that are giving us issues and what we're doing about them. We call those our problem children. So we're going to talk about those as well. So stay tuned because, like we always talk about, we don't want to just talk to you about our winners and everything that's going right. We want to talk about the messy middle, the real trading of what happens. And just because they're problem children doesn't mean they're going to be losers, but they're the ones that are giving us, cause for concern or increased levels of caution when we're managing our trades. And then finally, we're going to touch on what we would do with Bobby. If you don't follow Bobby, we'll put his X handle down below. And I'm going to screw up your last name here, Bobby, but Bobby Pluniak. I think that's a pretty good attempt at it.
It's pretty good. He must be Polish, right?
I don't know.
Sounds like it. Bobby, tell us if you're Polish.
Yeah. But so Bobby postured a question out there about, how would people trade his portfolio. So we're going to give our spin on it. It'll probably mirror a lot of the things that we currently do with our own portfolios. But, it's kind of like a game of Monopoly. It's someone else's money. So let's have an imaginary game plan for what we would do. And we'll each kind of discuss our own thoughts and opinions of what we would do. So
let's do it. Before we get into it, though, can I interrupt the regularly scheduled programming to talk about something that I was kind of dwelling on yesterday?
Okay, is this like a therapy session? What's going on
here? It's a little bit of philosophy, a little bit of therapy, a little bit of trading, all wrapped up into one.
Before he says anything, I have no idea what he's going to say right now. So let's go.
Right. So I don't know if you guys saw this. I don't know if you saw this. I'm sure you did. But yesterday or the day before, X announced that they were going to pay $1 million to the top article on X at the time. Or I don't know how they're determining what the top article is or the time frame. And since then, there have been a bunch of articles circulating around X. One of them caught my attention and probably caught all your attentions as well. Did you see this article, Nick? Do you know where I'm going?
I don't know where you're going. I did not think this would. No.
Okay. All right. So this article popped up on my feed a dozen times in like a few hours. This guy, Oh, now I'm blanking on his name. I'm blanking on his
We're
name.
recording, not the right time.
No, his name is not important. His name is not important. I apologize, whoever this is. But the article is called "How to Fix Your Entire Life in One Day." It has 140 million views and like 500,000 bookmarks. I was reading it yesterday, and the key point is you aren't where you want to be because you aren't the person who would be there. And I was sitting on that for a second. I was dwelling on that and thinking about.
Can you say it again?
Yeah. You aren't where you want to be because you aren't the person who would be there.
All right. My brain's not quite processing. It feels like a tongue twister.
And so what that means is the article is talking about how to change your life. And the problem that people encounter is they try to change their habits or their actions instead of changing the person that they are. And so if you want to get healthy and you want to go on a diet, you might go on a diet for 30 days and change your behavior for a while. But in the back of your head, you're saying, when I get off of this diet, I'm going to go back to, I can't wait to eat sweets again. I can't wait to get Mexican food again. It doesn't work because you're not the person that you need to be to have that result. It's a phenomenal article. Well,
so, all right, well, okay, hold on, because not to poo-poo it, all right? Like I said, I didn't know he was going to bring this up, but based on what you just said, I think a person is literally the habits that they have, the actions they take, and the thoughts they say to themselves.
Mm-hmm.
So to me, like personally, I don't believe in diets. Like, I think diets it's a horrible word. To me, you have a lifestyle. And if a diet is something that has a end to it, right? At least the way we use it as a colloquial term, right? Like, everyone has a diet. There's a Mediterranean diet, right? Like, we have like ways we eat. That's a diet. But we talk about diets as in sacrificing certain things. Like, I don't believe in that personally. I believe that you have certain lifestyle, certain habits. Sometimes those habits you kind of fall off a little bit, but then you get back onto your habit and you have a certain lifestyle.
That's exactly what he's talking about. That's the person that you are. And so maybe here's an example. Like, I feel like I'm drinking too many Celsiuses lately. We were just talking about that.
He shows up every time with a Celsius.
But making the decision to be like, opening that refrigerator and being like, you know what, I'm not going to have that Celsius this time. That's not effective. Instead, become the person that drinks tea every day instead of the person that's trying to avoid drinking Celsiuses when you open up the fridge. Do you know what I mean? You have to change the person that you are instead of just the actions that you take in that moment.
I guess, like, maybe I just don't think real world is like that. Like, to me, real world, sorry, I guess philosophy podcast today. To me, the real world is, can you do something for 3 weeks to make it become a habit? And once it becomes a habit, that is who you are. So, for example, like, one of the things, and we're all different, right? We all have the things that help us succeed in different domains. So what I'm saying is specific towards myself and people who think like me, probably. But I used to really struggle to work out in the mornings. I was always a after work kind of guy working out. But I got to a point where I really wanted to start working out in the mornings. But it was always hard because I was always tired. No matter what, I was always tired. And every time, like, the alarm goes off, like, just, like, I would sleep in. Like, sure, I could do a couple days, but then I would just fall off. And, I would still get my workouts in, but it'd always be in the evening. But I liked the idea of starting off the day with something for me, not for work, not for anyone else, something for me. And the way that I was able to become successful at getting up early to go to the gym to now, I always essentially work out in the morning. And it's like religion to me at this point. It's so consistent. But what allowed me to do it was taking a very small step and looking forward to a very small milestone. So right now, when my alarm goes off, I don't think about the gym. When the alarm goes off, I think about that cup of coffee I'm going to have. And that's all I think about. Sometimes it's so effective. It's such a small thing. And it's a little dopamine trigger in your head. It's so easy, so tangible. Just get up and go get your cup of coffee. You love that cup of coffee. But sometimes the night before, I kind of want a cup of coffee because I'm looking forward so much to that cup of coffee in the morning.
Well,
And that's what allowed me to be.
I think you're describing right now how you changed who you were. You went from a person that wanted to wake up a little bit later, that was tired in the morning, to a person that is energized by the idea of getting up in the morning, energized by the idea of having that coffee, by getting that workout in.
Yeah, that's fair. I mean, maybe I need to read the article to really understand what they're saying, because to me, that only happens by starting the habit. And that habits turn into who you are, but you have to start the habit and you have to do it long enough for it to become.
Yeah. Well, it does take actions to change who you are.
Yeah.
So I think we're saying the same thing. And by the way, his name is Dan No, GNO. It just occurred to me again. But let me tell you why I was ruminating on this article for a while yesterday. Ruminating. Yeah. I was ruminating on it because there's parts of my life that I wish I had changed who I was for a better outcome. And then there's some parts of my life, and trading is one of them, where I feel like I became the person right away to have the outcome that I wanted. And that made all the difference. And so, for example, you learned first that we could sell options, and you taught Junior and I how to sell options, and that was kind of our first introduction to selling options. But we started with this foundation, and then what did we do? We read the most seminal book on selling options for retail traders. And then we went to some conferences and we talked to the biggest figures in options retail trading. We challenged them with questions that we had that we thought differently than them. We spent probably a year watching and reading every single thing that we could on selling options from a retail perspective. And we've been successful at options trading. And why? When I was reading the article, I was asking myself, why were we successful? It's because we followed the path to become an experienced trader, and that results in positive, profitable results. And when I see some of the content on X, other traders that are advertising their services, advertising courses or opinions, I see them posting things that I know are not back tested and statistically correct. For example, there was a trader talking about how they sell options at 21 days till expirations and then buy back in the last week. And I'm like, that's statistically shown to not be the right way to trade these medium, 45-day trades. And in my opinion, that person is not taking the steps to become, he's not taking the steps to become a successful trader. He's not putting in that work. He didn't become that person to have the results that he wanted. So anyway, I was ruminating on that. I was thankful that we went through that process the correct way. And I would encourage everybody listening to this podcast to do the same thing we did if they have the ability to.
I like that you said that. I like the word ruminating too. It's a good word. We like words. Sometimes we exchange words. I never use that in my normal day-to-day lexicon. But no, I like that. Yeah. Do you think some of that, and then we'll get into the questions from the viewers, do you think some of that has to also do with passion and interest and, something that's really lighting a spark under you? Because for some people, just using the gym, for example, that just won't light a spark for them. They know they should do it because it keeps them healthy and all this stuff. But sometimes there's certain things that light a spark under you.
Yeah, I absolutely think you and I have been predisposed to trading in the marketplace for our entire lives. So it's absolutely something that had a strong pull to us. But I think we were lucky to grasp onto a sturdy foundation and build from there. Whereas a lot of traders, and even us earlier, you might buy a deep out of the money leap and hope that you're gonna make a lot of money. You're gonna 10x, 20x your money on this, and you're losing money. You're getting discouraged because you don't know how to do it. And we were lucky, or blessed, or however you want to describe it, to grab onto a solid foundation. When we learned about selling options, we were able to build that into who we are now, which is what are successful traders.
I guess maybe one more thing just before we go into the questions that were given to us by the viewers, listeners, people who follow us on X. We had a comment on one of our posts, I don't know, I guess maybe about a week ago now. And the question was, if these guys are making 20, 40, 50, 60, 70 grand a month trading, why are they doing courses? Why are they teaching people how to do this? Why are they, and the implication was that we're essentially, what's the word I'm looking for?
Fudging the numbers?
No, that we're a grift, right? Like we're just sitting there trying to tell people, hey, we're doing this. And then we sell a course and we're just like, a lot of these other, honestly, some of the ones that we kind of poo-poo on out there, that these gurus and all this stuff. And, it's like, I get the question and it makes sense. And shameless plug, January 31st, next options crash course. We're closing it on Wednesday. We got, I think, 1 or 2 spots left. So if you're interested, sign up now. Actually, one just came in as we were setting up. And then we're going to be closing it off. I think we might do one in February. That's still up in the air. We'll decide on Wednesday. But if you want, sign up for it. Anyways, it's a fair question to ask. But it's also coming from a self-serving point of view. So like when someone asks that and they don't understand, again, it's a fair question to ask, but we figured something out. I mean, okay, I figured out something, I systematized it, right? And what was the first thing I did? I wanted to share it with my friends. So I shared it with Junior, I shared it with you, and I taught you guys. It's like this thing, I'm like, oh my goodness, look what I figured out. I finally took all these puzzle pieces that essentially took 10 plus years to of making mistakes and having some success and making mistakes to kind of systematize something and really paint the whole picture. Brought you guys in, saw great success with you guys, brought a couple other friends in, started sharing my results publicly. People started asking me to put on a course to teach people. It's like, okay, well, let's try this out. Every time I did it, right, did it 4 times last year, more and more people signed up. Seeing all the great results people are having, they're allowing me to share it publicly, so that's awesome too. Being able to have you come into this, full time now, and now you're reaping the rewards from it. Now we got this podcast. Ben is helping us out, right? So it's not just about making money trading, but I love the teaching aspect of it. I love the giving back, hey, I figured something out. So I don't want to black box it. Like I know a lot of people want to black box their proprietary thing. I don't want to do that. I want to, look, the pie is ever growing. It's not like there's not enough for all of us. There's enough for everyone. But I like to share it. And the best analogy I can think about, we were talking about this, I don't remember where we were, but it was this past week we were together and we were talking about this. And to me, it's no different than Michael Jordan, LeBron James, Dwayne Wade, go on, name your huge all-star, Luka Doncic. They all have their own basketball camps. Like, are you saying to them, oh, well, if you're in the NBA, why do you have your own basketball camp? Why are you charging people to come to your basketball camp? It's for the love of the game. It's for the love of what we do. It's to share knowledge. I also love the whole quote of, you have a great society when old men plant trees that they'll never benefit from the shade. Mm-hmm. Like, what a great quote. And so to me, it's like, look, I'm not going to benefit from teaching any of you what we're doing and you guys being successful, but I feel like I'm doing a good in the world, and I think that, teaching others what you figured out and not black boxing it, I don't know. Selfishly, it makes me feel good.
Yeah. And I mean, to be clear, we are charging money for the course, but it has to be, we're putting a ton of effort into these courses. We're spending our money on this equipment, all that type of stuff. It takes money to make the machine work, but
yeah. Well, it's not like Michael Jordan doesn't charge. It's, back when I used to go to the basketball camps in Charlotte, North Carolina, it was $550 to attend.
Yeah, it's expensive.
Yeah. I had to save a lot of money to do that. Yeah. I don't know if you know that, but me and Mikey Ross, Carlos Scheckman, and Matt Wright all went together.
Yeah, I think I do remember that. All right, well, let's hop into the listener questions, shall we?
Let's do it.
All right, do you want to tee us off?
I will tee us off. So these are great questions, by the way. So thank you, everyone. If you want to get your questions answered or talked about on the pod, DM myself, DM Greg. Again, you can see our X handles down here. Somewhere it's here. I don't know where. You can DM us there or just reply to some of our posts. We tend to just grab interesting topics and put them in a note we share. Anyways, question number 1. What should you do when your favorite underlines that you trade on a regular basis are about to go through earnings and earnings are coming up and you probably don't want to trade them into or through earnings? What do you do?
That's a phenomenal question, in my opinion. And it's something that I face all the time. I have a few thoughts. The first one is, I don't know if you should have favorite underlyings. I think you disagree with me here. And don't get me wrong, I do have some that I trade the same ones over and over again, but it's a pretty wide breadth of underlyings. So I think you should be trading whatever has high volatility, that's a quality stock, and so I don't get stuck on those underlyings. The other thing I would say is there's kind of two approaches. The first approach, in my opinion, is you set your expiration date for before the earnings date. That way, volatility isn't going to be building into your expiration date, which is not good for your premium theta decay. But it'll prevent you from going through those earnings, and the decay will probably be greater, or it will be greater than the volatility expansion as you get closer to your earnings. That doesn't work, obviously, if you are 2 weeks from expiration. We don't recommend somebody sell a put or call with 2 weeks till expiration. So if that's the case, then you will be going through, your expiration will be after the earnings date. And in that case, what I would recommend people do is let those positions play out for those 2 weeks. Hypothetically, it's 2 weeks. Let those positions play out until you are going to take both of them off at the same time at a profit. And what I mean by that is I wouldn't roll the positions. Typically, whenever we have some profit in the position, at certain times we'll roll the position to a different strike to collect more premium. But I wouldn't do that as you are approaching expiration.
Okay. Yeah, I kind of have a similar take on what you're saying, maybe some tweaks. So first of all, I'm not against people trading through earnings, as long as you place the position intentionally to go through those earnings, right? Like I have no problem. I mean, we've both in junior, we've all done earnings trade. Sometimes we do them but when we do them intentionally.
Yeah, can you explain what an earnings trade is? Because I viewed this question as excluding earnings trades.
Well, what I'm saying is, so when I say you're doing it intentionally, what I'm saying is you're placing the position at a certain strikes with your own assumptions. Maybe it's both sides, maybe it's one side, but you're doing it intentionally rather than you're just falling into a earnings time window when that wasn't your purpose out the gate. So that's kind of what I'm trying to differentiate. But so I don't mind people doing earnings trades, again, because we do it. We don't do them that frequently, but when I do them, I have there's something that's the reason why I'm doing it.
Well, explain what an earnings trade is.
It's very complicated.
Well, so what I would say an earnings trade is you place the earnings, you place a strangle or just a put or just a call, short side, a short put, short call, or a strangle right before earnings. And the reason you do that is because volatility is expanding into earnings. So if earnings are after hours, you can place that strangle at 3:58 p.m., 2 minutes before the close of the market, and right before earnings, because premiums will be at its highest. And then after hours, as the earnings results come out, that volatility is going to plummet. And the next day you'll wake up that next morning. And as long as the stock didn't move significantly and into, for example, so that you're in the money, you should be profitable on both sides of those. But an earnings trade is like you're in there for, a little bit of the day before, and then you're closing out right away. So you're putting it on the night before, you're closing it out in the morning. It's a very quick trade. But the question that we're discussing, I think, is like, would you put on a strangle 2 weeks before an earnings, which I would not consider to be an earnings trade.
So that was a good way to explain the earnings trade in a very high level way. I would have gone way too much detail that we would have been here for 2 hours just talking about it. But yes, that is what we're here to talk about. But I just want to make the distinction that earnings trades aren't bad is what I'm trying to emphasize here. Would not make your bread and butter, that's for sure. But as far as where I agree with you, let me finish where I disagree. I disagree. I think you should have your go-to underlines that you trade. I think you do have it. I know you said you kind of have a different opinion, but I think at the end of the day, it's semantics. I think you do have your go-to trades that you go to, that you're going to put on your bread and butter, and because those are the ones that tend to have most of the premium, most of the volatility. Like, no one's not trading Tesla, Nvidia, Meta. No one's not trading those. No one. So to me, like, there are favorites. The favorites are the ones who pay the most and have the most volatility and have the most volume. Like, that's the name of the game. But to more directly answer the question, for me, if you're going to place a trade and you know there's earnings coming up, first of all, you should have that on your watch list. You should know when the earnings are going to come up before you place any trade. One of the things I like to do is I like to have an expiration date right before or right after earnings. And I mean like days, not like a week or anything like that, with the idea that I'll be out of the trade before that. Now, this can be dangerous, like Greg said, because if you're receiving profit on one side or the other and you decide to roll the position down or up to collect even more premium, you can kind of get caught, right? You can get caught because all of a sudden, what is there, that volatility, the premium price there, it might not get sucked out the way you think it's going to, because the binary effect of earnings is keeping a lot of premium into those contract prices. So I think 2 weeks is probably like a nice number. But I would say in general, if you're at 2 weeks, you really need to be very careful and understand that the theta decay is going to be very slow and very little up until you go through that earnings.
And are you saying you wouldn't put on a trade closer than 2 weeks till earnings? So you wouldn't put on a trade, a strangle, for example, 10 days before earnings?
No.
Yeah. So you'd be further than 2 weeks. So further than 14
Correct.
days.
But what I think a lot of people do is they'll put on a trade with, like, say 38 days to expiration. And, by the time they get, and then they're profitable. And they're profitable within 7 days, maybe 10 days. And all of a sudden they decide to roll down. Right. And it's like, oh, well, if it's 7 days or 10 days, still 28 days left. Right. There's still a lot of time. And they try to roll it down. And all of a sudden, you're not getting a lot of premium sucked out. The stock is kind of staying where it's at. Maybe it starts to move a little bit against you. And you kind of get put between a rock and a hard place. So when you place your initial trade, you need to understand when earnings are and where it's going to happen as it relates to the days to expiration you have. So if you're in that situation, though, maybe that's really, imagine if this question is being asked because someone's in that situation right now.
And I'm sure that they are, because if you think about it, companies have earnings every 3 months, and the earnings calendar is like 2 months long. So realistically, 2 out of every 3 months, you are in some type of earnings environment where if you've got 14 underlyings on like I do, one or more of your underlyings has earnings in the next 2-3 weeks.
But what would you do if you were in that situation? You got 2 weeks left. You got some underlines in. You're slightly negative in them. Like maybe it's Tesla, right? Tesla's got earnings coming up. Maybe it's a week, 2 weeks before. You're in there. You got a strangle. Maybe you're down, $1,000 on one side, $500 on the other. Like, what do you do in that moment?
I'm a huge fan of taking a small loss to avoid a larger one. Yeah. But that being said, if I have 2 weeks left, I'll wait to see how it plays out a little bit and hope that I can get out one side and then maybe the other side at a break even or at a profit. I mean, typically you would be, unless you've done some rolling recently, one side is going to be in the profit. So I may, depending on a lot of factors, like for example, how profitable am I for that month at that period of time? Is it early in the month? Is it late in the month? To me and to us, we're interested in how we are doing for the month and how we're doing for the year. So if it's, if I've made $45,000 that month and I'm not going to risk going through earnings on a trade, I'll take the $500 loss all day long. I don't care, but if that's not the case and we're talking about this in a vacuum, I'll try to take one side off at a profit and the other side, I'll try to wait until it's at just zero. I'm just even on it and take it off. But what I will not do is I will almost never go through earnings because I have no idea what's going to happen. Particularly, if we're talking about Walmart, okay, maybe that's, Walmart's not going to have a blowout quarter typically. Maybe it will. I don't know. But if
you said that about Target once.
Oh my gosh, I did say that about Target once.
I just opened up an old wound, guys.
Gosh, yeah. I'm still healing.
You're like, oh damn, we don't have bourbon right now.
Give me a drink now. But for a tech names can have a 10% swing. I mean, Lululemon had a 13% swing last quarter. So, and I think remember I accidentally went through earnings on Lulu. It turned out to not be that big of a deal because we did have that IV crush. And so it was, it was a small loss relative to my profit for the month.
But I have a similar answer as you though. Like if I'm in that situation, say we're down 1,500 on the tires trade. We're assuming a strangle here. Down 1,000 on one side, 500 the other. Pick whatever number you want. I will probably try to work it. And what I mean by work is like just pay close attention to it to try to find a more opportune time based on what the stock's doing to get out of one side or the other. To either take a smaller loss, maybe stay a decay does work out a little bit more, maybe the expect move comes in a little bit, just where you can take that loss but make it smaller. I mean, there's a chance you become profitable, right? Depending like how many, like if it's going to expire 2 days after earnings, like you might have a good chance of still making a profit on it, but you want to be very, very careful. And so, this is where I'm going to be working it. And like I said, working is like really paying attention to what's going on to get out clean or at a very small loss. Because again, you're going to take losses. And, sometimes like, hey, look, sometimes you're going to kind of get a little, I don't want to say gambling, but sometimes you're going to want to take a little more risk, which is like saying, I don't mind riding this out a little bit. Let's see what happens because it's going to expire the very next day after earnings. And I think we're going to have a lot of theta decay. Like there's not going to be a lot of value left in the contract, even though there's earnings. Like whatever your opinion is, that's fine. But it's going to be more work. It's going to, especially as far as you having to pay attention. But Greg, what you said was just so spot on. Whatever your profit is for that month, if it's 45,000, if it's 10,000, if it's 5,000, the name of the game is to take losses quickly and make sure that they're smaller than what you've already made for that month. And we like to look at things monthly because again, I forget what you did. So I think last month I did 40 something. This month, I'm up 20 something already. If I had that type of situation right now, I don't want to be going in thinking, well, I'm up 60 something $1,000 in the last 2 months. Like that's a horrible way to think about it. I want to think about, I started from zero at this start of this month. It's not because it's New Year's alone, but it's every month we start at zero and we have to earn our way back up. And as you do that, you want to protect what you've made for that month. So always thinking from that lens. So hey, you've made all this, take the loss. Who cares? I'd rather finish the month up 20 grand, than be up only like 3 grand.
Yeah, I did that. I actually did that earlier this week. Yeah, we'll talk about it later.
Cool. So, all right, let's continue. Great question. Fantastic question. Real world question. And
very real world.
We've been through that many times. I'm sure we'll talk. Actually, I'm going to talk about Meta later, which I'm kind of in a similar situation. Next question. So when we're traveling, right? A lot of people travel, whether it's for work, for pleasure, for whatever reason, you're traveling on the move. Maybe you have to take an airplane. Maybe it's overseas. Maybe it's just domestic. Maybe it's an airline that doesn't have good connectivity. Maybe you're out in some remote part of the world. What do you do as far as trading? How do you trade? What maybe precautions do you take? Like, what's your approach to trading when you travel?
I went through this last September. My fiance and I and another couple, we visited Jordan and Egypt, and I traded all through that vacation. We slept in the White Desert. We slept in Wadi Rum, another desert. We were in a lot of places that didn't have good connectivity. And I learned a lot during that experience, to be honest. What I learned is on a vacation, I love checking the stock market. I love checking my portfolio. I have no problem traveling around. If I was in Hawaii or I'm going to Colorado for a ski trip later, I'll trade all through that. No problem. But I like to pay attention to it. But if I'm going somewhere that I know is going to have spotty connection, or I'm taking a lot of flights like that listener was, what I'll do is I won't roll. And the reason I don't roll is we roll at certain times depending on market conditions, and to take profit, roll up to a higher strike, collect more premium. But when you roll, your position kind of starts back at zero and can go negative or can go positive from there. But if you don't roll, you don't have to pay attention as much because your strikes are going to be so far away from the current stock price that you don't really have to check it 5 times a day. You don't have to check it when you're on a flight. I mean, you should as much as you can, but that would be my advice. It would be if you're in a position where you can't check your portfolio regularly, spotty conditions, internet conditions, you're flying a lot, something like that, I would just avoid rolling or roll very cautiously.
Yeah, so I have a couple of things I do. So first of all, for work trips, for example, don't expect you guys all to do this. But the question was, what do I do? So I'm going to tell you what I do. I make sure that if I'm traveling for work, that my flight leaves and lands before the market opens, or leaves and lands, or leaves after the market has closed. So if I'm going to New York, if I go to New York, I'm going to make sure that by the time my flight lands, it's before the market opens so that I can have internet connectivity. If I'm going to leave New York, I try to make sure the flight leaves after 4 p.m. so the market's closed. So when it comes to work travel, to me, it's just cleaner that way. It's also nice. You get to airport kind of before everybody. There's less traffic, right? Like life kind of actually works out better that way when it comes to traveling. As far as for pleasure and leisure traveling, like we're going to be going to Italy here soon. I will always, and honestly, I do this even when it's before the market opens because I want to know what's happening, as the market's opening. But
I'm smiling. Something. Am I gonna be trading on my wedding day? What day of the week is my wedding day? Is that on the weekend?
It's a Sunday. It's a Sunday. I know his wedding day. He doesn't even know it. But when I'm traveling for pleasure, I always make sure I have good internet connectivity. So I choose. I fly Delta. One of the reasons I fly Delta, besides that I'm a Delta member, so my points and all that stuff, I care about it. And honestly, they got the best flights. They got the best first class, in my opinion. Emirates is pretty good too, but we're in the States. So Delta, I think, has the best. But anyways, I make sure I have good internet connectivity. I tend to always connect to the internet regardless. It's like $10, or if you're flying first class, it's always free. So that's what I do. I like to be on, and I'm a lot like you. Like, I'm a junkie. I'm a stock market junkie. Even on the weekend, we're doing this on the weekends. I love knowing what's going on. Every Sunday, obviously not this Sunday because we have MLK, markets closed tomorrow, but every Sunday I'm sitting there waiting for the pre-market to open to see what's going on, see how things are moving. So I love this stuff. I genuinely do. People always ask, like, how much work is it passive? Like, how much do I have to put into this? And it's like, and I always tell people, like, honestly, like it's very easy to do this and have a full-time day job. But the truth is, if that's all you want, something passive, like that's like the biggest myth ever. There's no passive income. That doesn't exist. Everything takes work, right? Whether it's a rental property, everything takes work, one way or another. So
I feel like that's like asking like a runner, how much work is it to go for a run every day or to go like to be a runner?
Yeah.
It's like, yeah, it's work, but it's what I do.
Yeah.
It's who I am. I'm a runner. I wake up in the morning, I go for a run, it clears my head, it gets me excited. Like it's the same thing in the stock market.
Yeah, no, I agree. It's like we genuinely love this stuff. So, make sure that if you're going to get into this, and I promise you, if you start to get into this, like get ready, you're going to get addicted to it because it gets addicting to win so many trades. It gets addicting to make money, on
Very
top
rewarding.
of this. But I'll say one other thing that I don't do if I'm traveling, especially if I'm like in meetings or in general, if we're at a winery and I just want to be able to enjoy myself, I won't do any like 0-day trades. I'll avoid all those. Like Greg said, like maybe I won't put on new positions. If I just want to like manage the ones I have, I'll just manage them to closer and I'll just let what's on there. I'll just manage those, but I'm not actively trying to trade as much as I'm just managing what I already have on.
That makes sense.
Yeah.
Yeah. Great advice on not doing 0 days. We have
okay, to be completely honest, I pride myself on honesty. Have I done a 0 day while traveling? Yes, but it's because I knew I was gonna be sitting there in a room all day with internet, just like on calls and stuff, like not really doing, I'm not gonna be moving around or anything. I'm gonna be sitting there looking at a screen. Like, all right, yeah, I'll place a 0-day trade in that situation, but not if I'm at a winery, or if we're going to a restaurant, or if we're going to go hiking, that's not the time to put 0 day.
We have a running joke in our trading group on 0 days. I'm a beach volleyball player. I've had knee issues in the past, and I go do PT every other Friday. And it seems like the market doesn't like us doing 0 days whenever I have PT. The only days it seems like that we're at all nervous about a 0 day is when I go to a PT session, and it's like a running joke. So now there's every time we place a 0 day, they're like, "You're not going to PT today, are you?" It's like, "No, I'm not going to PT."
Like
today.
I said, I pride myself on honesty. It's not a joke. I will literally take the opposite trade he has if he tells me he has PT that day. I'm not joking. Call me superstitious, but it's a thing.
Right.
All right. But great question. Real world question. This is literally what we pride this pod on being about. What we're trying to do, as much as we can, is bring in the real world to the theoretical. YouTube tends to always be theoretical, and we want to talk about the truth and messiness of life and how, trading actually works in reality rather than just theory. All right, so great question again. So let's see. Next question. It's about covered calls. And this user asks if you should have covered calls on all the time, regardless of implied volatility.
This is my favorite question out of all the questions.
Really?
And it's my favorite question because I tend to have my covered calls on my Tesla shares all the time. But I think there's two schools of thoughts here. There's definitely two trains of thoughts here. The reason I have covered calls on my Tesla shares for two reasons. One, I want to protect my account value, and two, I want to make money on my covered calls. I want to generate income using covered calls. To accomplish both of those outcomes that I want, I'll have covered calls on my Tesla shares all the time because as Tesla investors, we know Tesla can swing wildly between 200 a share and 500 a share. And you're much happier with your portfolio when it's at 500 a share than when it's at 200 a share. I think we're past those days, hopefully, knock on some wood here. But I want to protect my portfolio. And the way that I do that is by rolling down my covered calls and then rolling them up to a higher expiration as they decay. So I think it's the other school of thought is, yes, if volatility is low and an IVR on Tesla is in the single digits, it's probably a good idea to wait for volatility to spike. However, volatility is likely to spike when the stock decreases in value. If there's some event that causes Tesla to go from it's at 430 a share right now down to 350 a share, volatility is going to spike because something happened. And then you'll be selling covered calls at a lower stock price. So that's also probably not an outcome you want, because it could put you in a situation where your covered calls might even be lower than your break-even price, and that is never a situation that you want to be in. And I know I said a lot there that needs unpacking, and I'm not sure that we cannot unpack everything I said there, but those are the two schools of thoughts. So for me personally, I keep them on at all times for portfolio protection and for income generation, but it may be smart in some circumstances. This is a total maybe answer to wait until volatility is higher.
Yeah, all right, I'll answer it directly. No, I don't think you should have covered calls on at all times. I think you should do it when you have good premium there. I think you should do it when the stock seems to be capping off an upward move. What that strike is, what that premium looks like, right? We talk about a lot of that in our options crash course. But in my opinion, you shouldn't have covered calls on at all times. Going into a Tesla earnings, I don't want to have covered calls on. I just don't. I would rather risk it going down a little bit. It's whatever. You got the shares. Who cares? Like, the shares are going to do what they're going to do. I would rather not go through earnings with covered calls on normally. Maybe if we were at just all-time highs, that can get extremely wide. That's a little different, right? Every situation has its own nuance, but in general, I don't think it makes sense to always have covered calls on, because the other thing too is when you have those covered calls on, it can rob you of an opportunity to be able to place covered calls when IV does go up, and it can get you on the wrong side of it. Or then you do that and you have to roll up and out, but you have to take a loss for a second before you benefit from that new cover call you put on, and you're just kind of delaying things when you could have just been a little patient, waited a week or two, and then placed it again.
Question: How would you think about covered calls in different IV environments, though? Specific IVR for that underlying, not overall IV in the market, but would you sell covered calls in a low volatility if the IVR for that underlying is low in the single digits, for example?
No.
Why not?
Because I think that volatility is going to regress back to the mean, which means it'll go up.
Okay.
And so I don't want to go negative right away into that.
What about, would you sell covered calls when volatility is very high?
Yes.
And why?
Because I can make more money, I can get wider.
Would you agree with me that typically volatility spikes whenever it's more likely that a volatility event is going to cause the share price to go down than it is the share price to go up?
You said that. I disagree. I think there's lots of studies that have been done that volatility is not correlated to downward moves. Now, I know you're kind of hedging what you're saying there, but you say like normally, and I might agree with you normally, but that's probably just because normally that's where you kind of get caught off sides. But volatility can easily spike when things are going up. Easily. Like,
it certainly can.
Volatility does not equal stocks going down.
No. I'm not saying that it does, but it can certainly spike when there's macroeconomic events. When the VIX goes up, volatility goes up for a lot of underlying.
Like a perfect example, going to earnings. Okay, a lot of times there's a run up in the stock going to earnings, and going into earnings, volatility goes up, and guess what? Premiums go up, and the stock is going up.
Yeah,
perfect example of how volatility increases, premiums increase, but the stock's going up, not down.
Yeah, so I think the answer to the user's question or the listener's question is it depends on why volatility is going up. So should you put on, if you're not worried about your shares, if you're not in a volatile stock like Tesla is, or even if you're in Tesla, it's probably not a good idea to put on covered calls in a very low volatility environment for the underlying. And then if it is a high volatility situation for that underlying, you need to think about why is it a high volatility circumstance? Is it because the stock price has dropped 50% and you've lost 30% of the value of your shares? Okay, maybe it's volatility. Yes, volatility is high, but you might be in a situation where you're putting your covered calls on below your strike price. And then if the stock corrects and goes back up, you may be forced to sell your shares under your cost basis. And that's not a good result either.
Let me just, nothing's ever financial advice here, okay? But let me give you don't be stupid advice. You just said you should never find yourself selling covered calls underneath your break even. You're asking to lose money.
Yes, that's the point I was trying to make.
Yeah, that's idiotic. Just don't find yourself there. Don't do that. Whatever your break even is, you should only be selling covered calls above that.
Absolutely.
Like that should be like, that's binary. That's not opinion. That's objective. Like objective fact, don't do that. Otherwise, you do have a risk of losing money on your shares. Covered calls are brilliant because you can essentially, or you can't lose money. You're selling high. That's all you're doing. Selling higher than what you bought. Unless you go under what you bought the stock for, now we're playing in the territory of being stupid.
Yep.
Don't do it.
Yep.
It's like in basketball. You don't want to pass the ball. You don't want to jump in the air and then pass the ball.
Yeah.
Dumb idea. In soccer, you don't want to cross the ball in the middle of the field in front of the goalkeeper. Don't do that. Some of these things are just, don't do the stupid thing.
Right. And I think that's so important to highlight because it's not something that's going to be immediately apparent to you when you learn about covered calls and you start placing them.
Fair.
It's not something that you're going to realize until you hear somebody talk about it, like we are, or you experience it yourself. And then you're going to be like, wait a second, this is registering as a loss on my, in my brokerage. Why does it say I lost all this money in my brokerage? I made money on those covered calls. You did, but you sold your shares at a loss, potentially at a big loss. And so if you're watching this video, stick on this point for a second. Think about it for a second if you sell covered calls.
In general, whether it's selling puts, buying puts, selling calls, buying calls, break evens, if you sold both, how do you quantify your break even, all that? If any of that confuses you, that's, we do cover all of that in our options crash course. And I think we spent a good amount of time just thinking about how to concisely say this message so it resonates with people. I've done this option course a few times, and if you guys can see, I have a whiteboard right here of Greg and I just trying to figure out ways to help people better grasp these concepts. So we're always iterating on it, but it's definitely something that we cover. And it's extremely important to know what your break evens are, what your profit loss is, what does that look like? You shouldn't be trying to figure that out when a trade is giving you heartache, when you have your own problem children.
Yeah. It's such a strong point there. It's a great point.
All right, so let's see. This next listener asks, Greg and Nick, from a covered call perspective, does it make more sense to let my covered calls get called away and have the tax implication, or does it make more sense to take a loss and not have the tax implication?
Great question. It's one that every trader that's selling covered calls is going to run in that situation. And it's very situation dependent on your underlying and yada, yada, yada. But here's my advice. You're never going to be upset that you made money. So if you find yourself in a first world situation, first world problem where your shares got called away at a stock price higher than you were expecting it to go, but yeah, you didn't capture gain after that, you won, man. That's the game right there. You made money, and yes, you're gonna have to pay taxes on it, but that's a first world problem. That's a great problem to have. You're a profitable trader. Congratulations. That's phenomenal. So I would say you let your shares get called away. This is very situationally dependent. The other thing you can do is, first of all, I would never just close those positions and take a loss. Why would you do that? It really doesn't make any sense. What you can do is you can roll those covered calls further out in time to a different expiration, collect more premium and get even higher, And what you're doing is you're taking a loss at that time, but you're collecting the same or more premium that you'll profit from and make up that difference the next month, a month later, whenever, however far you roll that out to. The benefits of that are you are capturing that share appreciation to that higher strike price. You're going to recoup that loss that you took on the covered call when you rolled it. It's going to register as a loss, but you're collecting more premium or the same premium for a later expiration date. So you're winning on the share appreciation, you're winning on the premium collected, and you're pushing out the decision on whether what you're going to do if that share price goes above that new strike. So those are kind of the two approaches.
So I normally think that if you're going to place a covered call, don't do it unless you're ready to have your shares called away. All right. Like I say this a lot, that I think people need to, and I've been guilty of this, but they need to disassociate their emotional ties to their shares. And this tends to be Tesla investors, NVIDIA investors, Palantir investors, right? Which I get it. These companies have had, they've done so much for us. They've given us so much profitability over the years. But it's almost toxic to have such strong emotional ties to a share of a company. Like I get it, but look, even Elon has sold shares, right? Like it's okay to sell your shares. That's okay. Where you're not invested in Tesla to say you're invested in Tesla. You're invested in Tesla and Palantir, NVIDIA to make money. All right. And the only way you can make money is to buy low and sell high. That's it. And when you have a covered call be exercised and you get shares called away, you're selling high. Congrats. You won. You won. Now you have capital so that if Tesla has a pullback, every stock has pullbacks, you have capital that you can deploy, right? You have optionality. Now, as far as the tax perspective, look, if it's a long-term gain, even like, first of all, your loss that you'd be taking better be more than 50 grand to even be talking about taxes, because long-term capital gains tax is $0 up to 50 grand. So let's start there. Like if your FOMO, that is why you're even questioning this, your FOMO is so high that you don't want to get rid of your shares, you better have 50 grand upside that you're going to recognize pretty quickly to take that loss, right? Because that doesn't make a lot of sense. That loss won't be cheap. That loss will be 10, 20, 30 grand, whatever it is. So you got to think about that. Understand the tax implications. Even if what your risk is that it's going to be more than 50 grand, it's 100 grand. Even at 100 grand, your tax implication is only 15 grand, right? So it needs to make sense. And to me, the logic can't be, well, I think Tesla's going to 500 next month. I think it's going to go to 550. I think it's going to go to 600. Because too many people over the last 5 years have lived in this world, right? In 2021, we were at like 200 and something, maybe 300. We're not far off of that today. Like the reality is we're not. The reality is if you would have had a cover call get assigned or get called away back then, you'd be better off today because you've been able to buy way more shares. You could have doubled the total amount of shares you have right now. So don't regret or don't let fear get in the way. And if you're struggling to disassociate that emotional tie to those shares, just sell less covered calls. But there should be, if you're in this game to make money, there should be a portion of your shares that you're okay with getting called away a little bit, especially if you're getting paid for that potential, right? So I don't know how else to say it, but people just need to understand what they're doing when they do it. And covered calls are not the enemy. They don't make you a bear. It doesn't mean you're shorting the company. It doesn't mean you're betting against the company. Quite the contrary. If I sell a covered call, it means that I think that there's a chance the stock goes higher, and I'm willing to get my shares sold at that price. That's bullish, in my opinion. So that's my answer to the question.
Yeah, and you have a lot of optionality there. Like you said, you can decide to, if your shares get called away, you can sell puts at a lower strike And that way, if the stock goes down, you get assigned those shares at a lower price than you sold them at. That's a win, right? You can sell, if you should always keep additional buying power on the side. If you think you're gonna get called away, you can do things with that additional buying power, like sell puts before those shares get called away at that lower strike, knowing it's probably gonna get called away. And then if it retreats back, you can get assigned to those lower shares, or you can buy leaps, you can create synthetic stock. You can do some other things to capture that upside past your strike price and your covered calls.
And just rolling in general, like it can make sense to, like, I don't consider taking a loss, even though technically you are. But if you can roll out in time, like I wouldn't say like a year, but like if you can roll out 60 days, a month, 60 days, if you can roll out, collect more credit, like, why wouldn't you? Like, that makes sense. You're squeezing everything you can out of it. And that buys you time, but at the same time, makes you more money. And hey, maybe you get to keep your shares. But only if you receive a credit, right? Because that means you're going to make more money and cover the loss. But if it's a debit, that means that you're going to take a loss and make even less money. So you're still making a loss.
Yeah, particularly if we're talking about a stock that's near its all-time highs or at its all-time highs. Tesla's never breached 500. If my shares are going to get called away actually this almost happened, get called away at 485, and I rolled it out at 30 days and up to above 500, like 520.
And you collected more money.
And I collected more money. I'm like, okay, well, if it breaches 500 or 520, gets called away, fine. It's an all-time high. Thank you.
Just to use like easy numbers. So say he sold a cover call, and that cover call paid him $5,000, but now he's down, say, $10,000 on it, right? Because he's getting challenged, the stock's moving up. But now he can roll out a month, and it'll pay him $22,000. Well, that $22,000 will offset the $10,000 he's down, and he'll finish off with $12,000 if the stock closes out of the money. And that $12,000 was bigger than that $5,000 he started with, right? And that's what we're talking about. He received more of a credit. Now, if the stock keeps going up and he can't roll out in time again to receive a credit again, well, then he might be like, all right, that's it. Take it away. I won. I made more money. Stock's at all-time highs. I won.
Yeah, I won because of the share appreciation, and I won because of the premium that I collected.
And then to your point, if you rolled it out to 525, 530, and now the stock's at 600, guess what he gets to do? Well, he knows he's going to get called away at 525, whatever I just said, but now he could sell put at 540, at 550. He could sell at that same price, but he could do it now because he's like, oh, this is so far in the money, right? All kinds of things you can do, but don't just listen to what we're saying here and go away and be like, oh, I have options, and not know what those actually are. I see a lot of people do that. That is one of the reasons why we do a course to teach people on how to do this, on how to think through these, on the optionalities, no pun intended. But there's lots of choices. Taking a loss does not need to be one of them.
Yeah. Yep.
All right. I think it's your turn to talk about your thing.
My thing, the perfect market theory?
Yeah,
all right, well, let's talk about the perfect market theory. So what is the perfect market theory? The perfect market theory it's a shorthand for the assumptions that underpin the Black-Scholes model. It creates this theoretical, frictionless world where option prices take into account perfect information. And an analogy of that is like a farmer's market where there's 100 different stands selling apples, and there's no cost to buying at these stands. Everywhere has the exact same taxes. All the apples are exchanged under the exact same conditions. So the assumptions in the Black-Scholes model for the perfect market theory are, for example, there's no transaction costs, no taxes. The underlying borrowing and selling of that underlying is at the risk-free rate. There's no arbitrage opportunities, meaning somebody doesn't have asymmetrical information. There's constant volatility, and there's a logarithmic distribution of the underlying stock price. And so my question for Nick is, do you believe in the perfect market theory? Because the perfect market theory would suggest that you can't make money selling or buying options, because everybody has perfect information, as if you were at this farmer's market where everybody's buying and selling apples with all the exact same information, the same prices, there's the same conditions. Nobody's like, oh, I've got like a secret bushel of apples that have unique properties to them or something like that. So Nick, do you believe in the perfect market theory?
Okay, so I didn't. He told me he wanted to talk about the perfect market theory. I didn't know where he was going to go with this, but it's funny the way you position the question, because with I had an interview with Dr. Jim Schultz. Go check it out on Investing Against the Grain. Actually, while we're at it, why don't you guys like and subscribe to this podcast as well? Anyways, and he talked about when he was back in his days of academia that they believe that there is no edge that in this perfect market theory, right? And so it's interesting because I don't believe in it. I think you have two different worlds. You have the academia theory world, which I also equate with a lot of YouTube. Ironically, or hypocritically, I'm sitting here and we're just going to air on YouTube and on X. But I think 99% of all the content on YouTube, maybe even that, the only reason I don't say 100 is because we're on there. Not saying that we're the only ones. It's just we're the only ones I know of. But I think everybody talks about theories, and people talk about studies, and people talk about like they don't say this, but they talk about how things work, and it's always in a vacuum. The truth is the real world is different. The real world is uglier. Maybe not uglier. The real world is more complex than distilling it to some simple chart or line graph or some simple theory. On paper, it sounds beautiful, sounds like it makes sense, but the real world's different. For example, patents, right? You're a patent attorney. Patents distort that completely, right? A pharmaceutical company can have a patent for 5, 10 plus years, and that distorts the competition because it's essentially a monopoly in a way, right? And so that in itself breaks the whole the whole market theory. Another example would be branding, right? There are brands that have done such a good job putting marketing into it, even if it's just as good as the next thing. That brand, that reputation, that athlete, sponsoring that thing makes a huge difference. I mean, I can make the argument all day that Teslas are the best vehicles, the safest vehicles, the least cost for maintenance and all that, yet you still see Ford and GM sell more per year than Teslas do, right? Like, that is a difference.
So are you, in these examples, are you saying even though the products may be generally equivalent, branding is kind of asymmetrical information that means somebody wouldn't buy or sell?
Well, it's not just the information. I mean, because it could even be input costs. Tariffs change the input costs on shipping something, right? If someone in China has the best product in the world, but it costs X amount to bring it here, that breaks the perfect. Here's another example. Use the farmer's market. A farmer that lives closer to the city rather than in rural America may have faster information about new trends, new things that people are doing in the city where the vast volume of produce are bought than someone out in rural America. And so there's an edge there. So there's all kinds of real world examples where there's edge or rules that we've put into place or different spins on things like marketing and branding that make it so it's not in a vacuum.
Right. And so here's why I wanted to put this issue to bed on the podcast and in my own mind is because the perfect market theory would assume that stock markets, or imply that the options market is going to perfectly price options so that you can't be a profitable trader over time. And I just think that's baloney. I think we're evidence that's baloney. We're making profit month after month after month with the trading system that we have. And what I wanted to do was kind of look under the hood of the perfect market theory and say, these are the reasons why I think the perfect market theory is bogus, is theoretically okay. But like you're saying, real world events make it such that we're never in a perfect market.
I might be like a little ahead of you on like going down this rabbit hole you're going through, because I've gone through it before myself.
Right.
So what the next rabbit hole you'll go down is, okay, perfect market theory has been disproven, like in general, like it's pretty logical that it's not real. But then you go into, and Tom Sosnoff talks about this a lot. He believes in this.
The perfect market theory. Exactly.
No, efficient market theory. Perfect market theory is different than efficient market theory. Efficient market theory distills everything just down to information. And so the efficient market theory says that nobody gets an edge by knowing anything because everyone knows everything at the same time. So like, here's an example Tom Sosnoff will put out all the time. He'll say, hey, if I tell you right now that Trump's going to go and invade Venezuela, take their leader, and I tell you that before the stock market opens, what are you going to do? And I use this as an example because I would say 99% of people would have said that they would be buying puts or selling short. Market went up. Market went up. We see that with economic numbers all the times, where people say bad news is actually good news for the market, or good news is actually bad news for the market, right? Because if it's good news, right, if inflation's coming down, if the job market's going up, Fed's not going to cut rates, right? So Tom, he believes in the efficient market theory and thinks that even if you had the information, you wouldn't know what to do with it. You wouldn't know where to place it. And I disagree with Tom on this vehemently. And I have a good example, but I'll pause to let you reflect on that.
Well, I think that, why the perfect market theory or the efficient market theory is interesting to me is because it helps answer the question, can you be a profitable trader over your life? That's what's important to me. And the answer, as I have learned, is yes, you can be a profitable trader by taking advantage of asymmetrical information, by asymmetrical strategies, exit rules, entry rules, momentum indicators, all those types of things give you edges that result in a net profit for you. And there's looking at often the perfect market theory is what is used to say, no, you can't be a profitable trader. And that's just totally bogus because it makes some assumptions that are not accurate in the real world. And you kind of went into them, but three of them that I would want to highlight is it assumes there's no arbitrage. There's no asymmetrical information. And if we look at, like, for example, Tesla, I know where Tesla trades. Right now it's trading between 420 and 460 a share. If I can sell a covered call at 520 a share, I think that option is overpriced because it's unlikely that Tesla is going to breach up to 520 a share or go down to 250 a share. Well, their example I think is all-time highs in the example of Tesla because I've seen it trade between 200 a share and 440 a share for the last 4 years, right? So I know that, yes, it can get there, but is it likely to get there in the next 45 days? No, it's not likely to get there in the next 45 days. So I'm comfortable placing a covered call at Tesla at 520 a share.
So let me disagree with you a little bit. First of all, you mentioned you don't think Tesla will go to 500 in the very short term. You look at people like Pete DiCarlo, Fundstrat, Tom Lee, and forgetting his name, Herbert just had him on. They all believe that Tesla's going to break 550 within the next month and a half. All right. So, and those are people, and I bring them up because they're people who have been right a lot. And I always believe in listening to people who are right a lot. So that right there is like a little bit of a disagreement, right? Mm-hmm. The other thing that you said that I kind of disagree with is that I don't think that that's what they mean by information. I think information is more so reflecting, like I agree with what you're trying to say. Maybe just a different example, like with Tesla, where I think there's asymmetric information is understanding how good FSD is. The reason is because that's not information that's available to everybody. FSD is only really available in the United States. You have to own a Tesla and you have to pay for the subscription. That's a lot of friction points to get in the way of everybody having the same information.
Yeah, I totally agree with it. I totally agree with that. I was trying to give an example I was trying to tie it back to trading, why I'm comfortable selling at 520 a share. And Tom Lee and all those guys may certainly be right, but for the last 6 months, I've been selling covered calls at around 500 a share, and I've been banking on it. So, who's right? I don't know, but I'm pretty happy with where I'm at.
They didn't say it back then. They're saying now what they think is, again,
and fair enough.
They have been right nonstop about where the stock's going. So I just want to give them their kudos, but I hear your point.
And the other part of the perfect market theory that I strongly disagree with, and this is well understood, is it assumes constant volatility. And as options sellers, we know that volatility reverts to the mean and is expanding and contrasting constantly. It's expanding 15% of the time, it's contracting 85% of the time. And that's part of what we take advantage of as opposite sellers. It's our, in fact, our bread and butter is volatility. So assuming that volatility is constant through the options lifespan is just not real world at all.
Yeah. And just going back to like the whole Tom Sosnoff thing, because he talks about this so much that he believes in it and that you wouldn't know what to do. I don't really agree with him. Or actually, I vehemently don't agree with him. Let's just be honest here. For example, I gave the Venezuela example. All right, he may not be aware of what's happening there and how all that would play out, but I was pretty confident the market would go up after that happened. I did not think we're going to have a big sell-off. Now, another example in the markets, when numbers come out, I think a lot of times, where if you have good market awareness, that if we got PCE coming out soon, that if PCE comes cooler or comes out and hotter and you have good market awareness, you have, I think, asymmetric information just on understanding the current dynamics of the market about what the stock market is going to do based on that data reading coming out. So I do think you can make decisions if you had the information ahead of time. And that's, again, I use Tesla as a perfect example. We have that information, right? So many of you have, people are still baffled on Wall Street. This is just how you know that it is, real world is different.
People are baffled on Main Street. Every time I show people FSD, they are just shocked. I was showing people last night. We went to Golden Isles and I drove a few friends there. First, I showed them the acceleration of the Cybertruck, knocked their socks off. And then I was like, have you seen FSD? And they were like, yeah, I've seen FSD. And I put it on. They're like, whoa, this is way different than I experienced. And I was like, well, when did you experience it? Yeah. He was like, man, it was like a year ago. And I was like, man, they're updating it every other week, every month. Yeah. It is getting insanely good. But apologies, I cut you off there.
No, it's just I mean, again, in a vacuum, it all.
You're saying that Wall Street doesn't understand the asymmetric information about how great FSD is.
No, not even that. What I was getting at is they still don't understand how can Tesla be trading where it's at when they have declining sales, declining profitability, margins are compressing, but Tesla's still sitting here at these levels. It's a Mag 7 company. And so many of them think it's just overvalued. It's because they don't understand. They haven't seen it. They haven't experienced it. Honestly, it wasn't like David Faber is a great example, right? He's on CNBC. You're giving me a weird look.
I thought David Faber was the UFO guy from Joe Rogan.
That might be a similar name, but not what I'm talking about. David Faber is on CNBC. He's the one that interviewed Elon maybe 2 years ago after their earnings release. And he tried FSD for the first time like a year, maybe like 9 months ago. And he comes on air talking about how good it is. It's like, you're telling me you're in this space of Wall Street. You know that Tesla's one of the biggest companies in the world. It's one of the most traded companies in the world. And it's the first time you're experiencing the main product that they offer, that the CEO is saying, hey, if you don't believe in autonomy, sell our stock. Like, if a CEO says that, how do you not go out and see, like, okay, what's this thing about? Like, what's he, like, a CEO saying, sell our stock if you don't believe in autonomy. Sell it. I don't want you in it, is what he said in an interview with Kilowatts. right? Like how does that not trigger you to go? So anyways, my point is information is asymmetric. And if it wasn't, you wouldn't have a Warren Buffett. Why was Warren Buffett able to be so successful, right? You insider information, we have that all the time, right? Why is Nancy Pelosi doing so good? Even if you don't think that that's what's happening there, why does Congress outperform everybody, right? Martha Stewart, we know what happened with her, right? Inside information still happens. So people get information sooner than later. Jason Kalakanakis, or however you say his name, from the All In podcast.
Sound right.
I try to say it really fast. But he got a tour of the Optimus, I don't want to say factory, build room,
design
whatever
studio,
it's called. And he got to see Optimus 3 when no one else has. And guess what? He still gets to invest in stocks and stuff. Like, people have information. It's not an equal market. It's just not. So I don't believe in the perfect market theory. I don't believe in the efficient market theory. These are theories for a reason. And personally, I think that we all can have edge. It's just not going to be extreme apparent edge. But the best edge anyone can have is understanding, especially in our world, how do options work? How to trade them properly, how to leverage, everything. If you guys take the course, you'll hear me talk nonstop about how we're layering advantages in our favor through knowledge in order to place the best trade, to be able to place the most efficient trade. And it's like 7 or 8 different, points that we're stacking in our favor, so when to place a trade so that it has a high likelihood of working out in your favor. There's a reason our trades on a monthly basis, we win. Like right now, I'm at 92%. I've won of all my trades. I've only lost 3 trades this month. That's it. So there's a reason for these things. So anyways, I'll get off my soapbox there.
Let's hit our problem childs.
Yeah. All right. Our problem children.
Children? Why do I say child?
I don't know. You're the patent attorney. You're supposed to be good with grammar here.
Yeah.
Our problem childs, as Greg likes to call them. Let's talk about what these are first of all. So,
what is a problem children?
We stole it.
Now I'm like, what is a problem child? Child singular, children plural. You got this.
Well,
man.
maybe you have a problem child. I have children. So a problem child is well, first of all, credit where it's due. Tony Batista, who I interviewed recently on Investing Instagram, go check that out. And Tom Sosnoff, who've mentioned a couple times. It's a term that they coined for trades that are making you uncomfortable. Not exactly, you're not in trouble. It's not saying like, hey, you should be taking a loss right now, but they're not easy. They're not the easy winners right away. And so they're the ones that you're kind of managing, kind of keeping that close eye on, the ones that are kind of giving you a little heartburn.
The ones where earnings are approaching.
Yeah. They're the ones, if you really think about it, they're the ones that are going to decide if you're a winning trader, if you're going to have a profitable month, or if you're not. Because you have to be able to take a loss quickly, or you have to understand how to manage them and what mechanics to use to manage them efficiently. So that's what children are. So Greg, why don't you talk about what you've got going on right now? And last thought, the whole point of this is to, again, not only talk about the good side of stuff. We want to talk about like the real world. I keep saying this, but it's so important for you guys to understand that you can see a whole bunch of things on YouTube, but the real world looks so different.
Right. And so volatility has been really great lately since going into the beginning of the year. I've said that several times on here, but and it's resulted in honestly not a lot of problem children for me lately. I posted about this on X. I took a loss on ServiceNow this week. It was at the conditions where our trading system said it's time to close, and I could have held on a little bit longer. ServiceNow has not been performing as well as the other QQQ related stocks that are benefiting from AI, the AI boom. And so I decided, I'm up 20 grand for the month already. It's halfway through the month. I think I was up more than that. And I took a $4,000 loss or $3,000 loss just to say it's not worth it. There's no reason to keep it on. So I took that loss. No big deal. I posted this on X. I posted what went wrong. Nothing. Nothing went wrong. It doesn't mean something is going wrong if you're taking a loss. And that's really important to internalize as a trader, because you're not expecting to win every single trade. You're expecting to win, probability wise, statistically, 85% of your trades. Yeah. And so those other 15%, just cut them at a loss. You're going to make profit on 85% of your trades. The other 15%, just get out of them when your mechanics say get out of them. You don't need to go further analysis. I mean, when you're new, you should. Did anything go wrong in this situation? Did I put it at the right strike? Was volatility high enough? Did I accidentally go through earnings? All those things you should be aware of. You should reflect on. But if it's just a bread and butter trade that just is moving against you, you're in the money, whatever, and you decide to close it, not a big deal. So close that trade. I have, of my 14 underlyings, I have one potential problem child that's AMD. I'm down 200% on that. Nothing's crazy. Go ahead.
200% of the premium received.
Yeah, 200%. I think I have a strangle on, which means I've sold a call and I've sold a put. One side of it is currently down 200% of whatever premium I received on that trade. And it's something I'm just monitoring. Nothing to be concerned about right now. Stocks fluctuate in price. I'm sure it'll fluctuate. It'll probably end up being a profitable trade, but I'm just keeping my eye on it.
So I got a few problem children. So let me talk for a while here. So first of all, I've got lots of leaps that are now just long calls, not leaps, because we're under a year. So, those are, I consider them problem children. I mean, I got lots of time, right, to let those pan out, but, we don't do a lot of long positions unless opportunity presents itself. And, again, opportunity presents itself. I did everything right. Like the Tesla ones, we talked about this for a couple of weeks. I was driving. I called Greg. I told Greg, I'm going to get out when I get home. He wasn't going to get out. He did get out. After I said that, I get home and we're back down. So I'm still working with that one, still, wrestling it a little bit, doing some interesting tactics to try to continue to collect a premium on it. It's not too far out of the money. It's real close to being in the money. It's at 470. So it's not too far, but it's just, it gives me more heartburn knowing that I had a profitable trade that I should have gotten out of. I should have pulled over the car and gotten out of it. But again, I thought I had time. So that's the long side of it. And then as far as selling, I only have one. It's Meta, and it's funny that we had the question about the earnings. I've got a strangle on Meta that I rolled. Actually, no, excuse me. I got two. I forgot what this other one I'm looking at. I've got that I rolled, and I thought I was good. We talked about the 2 weeks. I rolled both sides closer, and we had maybe maybe 17 days. And I thought I would be fine. And, I'll be honest, I broke my own mechanics. I probably shouldn't have done that, but so now I'm working it, is what it is. But, now I'm working it, and that just shows you, break mechanics. As far as breaking mechanics, I broke my managing mechanics as far as when I should have rolled out in time, or just said, nah, I'm not gonna put another position on. But I still kind of have an opinion on Meta right now. And I do think I'll turn out to be right. But what I won't do is take a bigger loss than what I need to, right? That mechanic is a non-negotiable for me. So I got Meta I'm working with right now. And then the other one, stupid me. I saw Greg post on X a couple trades he placed, and he put the underlines. I'm like, oh, let's take a look at these. And I saw Micron, memory chip company. And I was like, you know what? I'm going to sell some calls on there. Sell some naked calls on it. I do a lot of naked trading. Greg does a lot of naked trading. But so
we're not naked while we trade, to be clear. It's a term of art.
Okay. News to me. I tend to be naked. Anyways,
That just means you don't have the shares if you're on the call side. You don't have the cash if you're on the put side.
correct. You don't intend to own the stock. You're just trading the contracts. But so I decided to follow him into Micron, and sure enough, the very next day it goes up 10%.
Yeah, what's with that?
Yeah, it's your bad luck once again rubbing off on me. He can copy my trades and he always ends up good. If I copy anything he does, it ends bad for me. I don't know what that's all about, but I should learn my lesson by now. I don't need to follow Greg. Let him follow me. That's fine. But it's actually kind of BS that it always works out for you.
Yeah, well,
it's kind of like, what the hell?
and my Micron's doing just fine.
No, it's not. Yours is down too.
Down
On the call side?
Yeah, it's down on the call side. It's down 100%. But
Okay.
it's not, that's very normal range of trading when you're in a strangle.
Yeah, but Micron is ripping. It's been ripping.
I'm only down 100%.
Yeah, well, I mean, I'm down. I just had it 136%.
All right, so that's very normal trading range.
It's normal, but it's not. It's not. I would say it's a little skewed because the very next day we went up 10% on the stock. And I'm like, what the hell?
That was weird.
And so, if it would have just been normal, this would probably been a normal trade already. But again, those are the things you gotta watch out for. So, like Greg's right. Like if you looked at my screen right now, everything's red. Like
it's always red.
it's always red. Why? Why is it always red, Greg?
Well, because you're taking profit when you can.
Because when you see the green, we're taking it off. So our portfolio or our trades are normally always red. That's another thing. It's hard for people to get used to. Like there's gonna be a lot of red. Of course, there's gonna be red because it takes time for these contracts to work, right? Like I think I did not a study, but I kept track. Was it 2024? Yeah, 2024. I kept track of how long it took for each trade of mine to go profitable. And it came out to an average of about 3 to 7 days is where all of my trades ended up. So anyways, that being said, like when you have yeah, we could just leave the profitable trades on and we'd have a lot of green on the screen. But the idea is to take the green off, place a new trade. And yeah, we're not great at timing like this. We're not trying to be great at timing. So a lot of times they'll go a little negative. Stock goes up, stock goes down. But in about 3 to 7 days, sometimes longer, it tends to flip over back to the green side. And guess what we do then? We take it off so we can place another trade.
And then it's red again.
Yeah. But so those are my problem children right now. I know you don't consider Micron for you, but it is for me just because it's annoying to me what happened. So it's not that I'm down on it. It's that I'm pissed off about the move it did the day after I placed the trade. And then Meta, that's one, again, like it's earnings are in 12 days. Expiration's on the 30th. So expires 2 days after. So that's one where, I'm at, my strikes are 615 and 650 and we're at 620. So I'm sitting there with it, just waiting. Like I can see that the expected move is shrinking every single day or going through his 3-day weekend. So
there's a lot of expiration dates or a lot of underlyings that have expirations in the tech industry on January 28th and around that time, January 28th, January 30th. So you always want to when you set up your trading profile, you always want to have a column for expiration dates. And I like to keep mine very close to the left side of the screen so that I am always aware of when that expiration date is.
Yeah, I do the same thing. Well, yeah, our screens are set up the same. Last topic here, Bobby, friend of the pod, he put out on X out of curiosity, how would we trade his portfolio? He's got a portfolio about $5 million liquid. So some of that's in Tesla, some of that is QQ, some of it he has cash. But so, he put it out there. And so, Greg, how would you trade his portfolio with the combination of some Tesla, some QQ, some cash, total aggregate about 5 million roughly?
The first thing I would do is I'd recognize that $5 million is going to compound pretty quickly. Right? At $5 million, you're not trying to make 50% gains a year, 200% gains a year, anything like that. You are balancing income generation with wealth creation, with keeping your portfolio safe. So for that, with that in mind, I'd have a significant amount in Tesla because, as everybody knows here, we believe Tesla is a revolutionary company, and should have a fantastic 2026. So I'd have a few $1 million in Tesla. I'd have a few $1 million in something like the QQQs, like he does have, but I would use covered calls, deep out of the money covered calls, to generate income, and I'd have deep out of the money puts for income as well. Those are in addition to that. I mean, if you have $3 million in Tesla shares, you can probably generate $20,000-$30,000 a month in covered call income generation profit, while placing your strikes pretty far out at maybe, if you're looking at 45 days, maybe 520 a share right now, something like that. You may not want to do that if you're concerned about your shares getting called away, but I wouldn't be too concerned with it at that point. And I would keep a significant amount in cash as well for taking advantage of additional opportunities, like if Tesla pulls back a little bit, for example.
So if I was Bobby, and I was starting from scratch, I would keep all my Tesla, however many Tesla shares he has, I would just leave that alone. I know it's not his entire portfolio, it's not Tesla. Like I said, there are things like 500K in cash, some in QQQ, some in Tesla. I would maybe sell, like, again, right now, I don't know if I'd be selling cover calls right now against my Tesla share, because personally, I do think we're going to run up into February, March. I'm kind of in the Tom Lee camp and Pete DiCarlo camp. I think that's what's going to happen. Before I think we see sell off into the spring, summer. But so I would kind of wait for that opportunity to sell more covered calls. I would probably bring in my cover calls. He likes to do them pretty far out in time, at least based on what I've seen. He likes to do them pretty far out. I'd pull that in to a closer time frame. And then I would be selling puts in a lot of other companies, Mag 7 companies that are kind of undervalued at the moment or have good pullbacks. So like Meta, Nvidia hasn't gone anywhere. Palantir's chilling out for a while. These companies are just kind of creating a base right now. And that way I could get a position into them. I would also maybe think about getting out of the QQQ, maybe taking my gains in that and selling puts on the SPX with the idea of acquiring SPX instead of, or you could do SPY if you want, instead of having the QQQs. And I would probably because if the idea is that he wants to have some exposure to like an index, right? I'm personally more of a fan of the S&P, but I would sell maybe more aggressive, like we have with the way we do our 0 days, but in this case, I would still kind of do a 45 thing. And I would maybe look to being at like a 15 delta on those, because those would pay some nice premium. So I would probably do that as a way to also acquire. And then I would probably try to maintain a little less cash than what he has right now. Just because right now I feel like it's a good time to deploy it. Listen, just my own bias. I'm probably gonna be wrong on this, but I just think that we're gonna have another little bump up in the market as a whole. I think Tesla has a date with 500 plus, and I think the S&P has a date with 7,000. So I think that's what's coming here. And I think spring, summer will be kind of a chill out period or a pullback.
Love it. Well, there you have it. I would just tell Bobby, keep doing what you're doing because you're doing it right. It sounds like.
Yeah, that too, right? Like, I mean,
obviously this is a fun hypothetical.
Fun. Yeah. And it's also easier to play with other people's money than your own.
Absolutely.
All right.
All right.
Episode 6 under wraps.
In the books.
All right.
Cheers guys.